Welcome to this video from CAPM Academy. In this video, we will now focus on estimating a firm's cost of equity using the capital asset pricing model. Let's dive in. Risk is the possibility of actual returns of a security differing from the expected ones that were estimated for the future by the investor. In finance, there are two types of risks: systematic and unsystematic risk. Systematic risk, also known as market risk, is the risk all securities experience in a given market. This risk cannot be eliminated through diversification since it affects the entire market. Factors like inflation, currency fluctuations, taxation, or legislation changes, natural disasters, election results, and more contribute to systematic risk. On the other hand, unsystematic risk, also known as company-specific risk, can be diversified away through proper investment strategies. Unsystematic risks include competitive risk, financial risk, operational risk, and strategic risk. The two charts show the risk of a portfolio measured as the standard deviation of the portfolio's returns. The systematic risk of the portfolio remains the same, independent of the number of uncorrelated investments in the portfolio, contrary to the unsystematic risk, which can be reduced by adding uncorrelated investments to the portfolio. CAPM assumes that investors hold well-diversified portfolios, which means that unsystematic risk is mostly diversified away. The remaining relevant risk factor is the systematic risk, and this is what investors are compensated for. Cost of equity is the risk-free rate plus the beta multiplied by the market risk premium plus the country risk premium. We will now go over the various inputs for the CAPM model, give definitions of each variable, and explain how they are estimated or calculated, starting with the risk-free rate. The concept of the risk-free rate plays a vital role in understanding investment returns. Theoretically, the risk-free rate is the return offered by an investment that carries zero risk. It assumes no liquidity, reinvestment, inflation, or default risks. However, this is quite unrealistic, as all securities have at least some degree of risk. In practice, the risk-free rate always at least reflects inflation. Investors expect to be compensated for the opportunity cost of investing in a riskless investment. Thus, the risk-free rate expresses the return rate compensating for deferred consumption or missed opportunities of investing in other financial securities or markets. The risk-free rate is often determined as the zero-coupon government bond yield. For U.S. markets, the 10-year Treasury note is commonly used, while European securities are frequently benchmarked to German government bonds. It's crucial to select the right benchmarks for calculating the risk-free rate. The benchmark should match the duration and currency of the future cash flows an investor expects to receive. As a result, when performing business valuations, risk-free rates applied will differ by regions or countries in which investors purchase, keep, and trade their securities. Another factor to consider is the country risk premium, CRP, which is the additional return an investor demands for investing in a security from a certain country. The risk premium incorporates various macroeconomic and geopolitical factors. Typically, developing countries exhibit higher country risk premiums. Credit rating agencies like S&P, Moody's, or Fitch assign credit scores to countries based on their credit performance. Alternatively, investors can use the credit default spread, CDS, of a country to determine the country risk premium. The CDS spread is the difference in yield between debt instruments of similar maturity but different bond ratings. The country risk premium is added to the capital asset pricing model, CAPM, equation and is never reflected in the risk-free rate itself. Next, we'll explore the concept of the market risk premium, MRP, an essential component in determining the cost of equity. The market risk premium represents the extra return over the risk-free rate that compensates investors for exposure to non-diversifiable risk. It's the difference between the expected market return rate and the risk-free rate. The MRP needs to be forward-looking to accurately estimate the cost of capital and the discount rate for a company's expected cash flows. When determining the MRP, keep in mind the following consistencies. There should be a fit between the market risk premium and the market region, and the inflation rate included in future cash flows should reflect the inflation rate embedded in the risk-free rate being used. There are multiple approaches for determining the MRP, each with its own purpose and perspective. For intrinsic valuation, the ex-post approach is most commonly used. This method calculates the MRP based on historical market and risk-free rates over a long period, making it long-term oriented. The ex-ante implied method uses the current implied internal rate of return of the whole market compared to the risk-free rate, offering a present-day perspective. The ex-ante survey method is the least frequently used. In this approach, economists are surveyed to provide estimates of market rates. It is rarely employed due to the lack of evidence supporting the accuracy of predictions. Next, we'll explore the concept of beta, a measure of systematic or undiversifiable risk. We'll discuss its significance, interpretation, and calculation. Beta measures the volatility of a security compared to the market as a whole. It reflects the degree to which the returns of an individual stock differ from market returns. The market beta is always equal to 1. The beta greater than 1 indicates that the investment is more volatile or riskier than the overall market. In other words, when the market goes up or down, this investment is expected to experience larger price swings than the market. As a result, the cost of equity will be higher for investments with a beta greater than 1, as investors would require a higher return to compensate for the additional risk. In this case, the investment's price movements are expected to be smaller compared to the market. Consequently, the cost of equity will be lower for investments with a beta less than 1, as investors would require a lower return due to the lower risk exposure. An important distinction exists between unlevered, asset beta, and levered, equity beta. Unlevered beta measures the systematic risk of a company without the impact of debt, while levered beta takes debt into account. For calculating the cost of equity, we use the levered beta. The levered beta, which represents equity risk, is always larger than the unlevered beta, except in cases where a company has no debt. For an unlevered company, its equity and asset beta are equal. This is due to the increase in risk for shareholders as the company's debt obligations rise. When determining the cost of capital in a business valuation, the beta is often derived from the betas of comparable companies. This method is particularly useful when a company's industry peers share similar characteristics and risk profiles. Follow these steps to estimate your company's beta. First, gather the equity betas for each of the identified comparable companies. This information can typically be found on financial websites or databases, such as Yahoo Finance or Bloomberg. Before we can use the betas of comparable companies, we must make sure we are comparing apples to apples. Because equity betas are impacted by differences in debt levels, we must recalculate the equity beta back to the asset beta. Use the following formula to unlever the betas. Unlevered beta is the levered beta divided by 1 plus debt divided by equity multiplied by 1 minus the effective tax rate. Next, we can calculate the mean or the average of the asset beta of the peer group. Generally, the mean is applied. Finally, we can relever the asset beta based on the target debt-to-equity structure of the company that is being valued using the formula. Equity beta is asset beta multiplied by 1 plus debt divided by equity times 1 minus the effective tax rate. In practice, the beta is often calculated based on a linear regression between market returns and stock returns, with the slope of the line being the stock's beta. The graph shows the stock returns plotted against the market returns. The linear regression line represents the modeled relationship between the two variables. The slope of the line is the stock's beta. In this case, the beta is 0.9576. Alternatively, the beta can be calculated as the covariance between the market and an individual stock's historical returns divided by the market variance. Variance measures the variability of the market. In simple terms, it is the average value of how spread apart the market returns are as compared to their mean. Therefore, the larger the variance, the bigger the deviations of average returns from their mean, or average, return rate. Covariance measures the directional relationship between the market returns and returns of an individual stock. How to arrive at the inputs needed for beta calculation is beyond the scope of this course and will be further discussed in an advanced valuation course. For now, it is enough to understand what a certain variable measures. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.